Hello guys, this will be my fourth video on my series Bankruptcy or 10X, and today we're going to be looking at Conn's Inc., ticker symbol Conn. It hit a peak of $30 a share and now it's down to $2. They're going through a lot of things. People are pricing in bankruptcy, it looks like, so that's what we're looking for. And I want to say before I start this video, especially on this series, guys, is these stocks are highly risky. I will say mostly all of them will probably go to zero. So invest at your own risk. The stock could easily go to zero. And yeah, so that's just my disclosure. And I also want to say we're looking for stocks that people are expecting to go bankrupt, but they don't, and they make it another year, and these things will absolutely skyrocket. That's what we're looking for. We're looking for gambles, basically. All right, guys, let's get right into the video. You guys, it would not be a stock video without Excel, of course. We had to pull it up. But if you guys want to hear about, types of bankruptcy and all that, go watch my other videos that I have, and I'll explain it there. But when we're looking at bankruptcy risk, right, guys, we're basically looking at three main things, and that's the current assets and current liabilities and the liquidity. And why are these important? Because your current liabilities are liabilities that need to be paid within a year, and if you can't pay your liabilities, you go bankrupt. That's just how the world works. But this company only has 466 million in current liabilities, and they have 1.2 billion in current assets. I think that's like a ratio of 2 almost. So do I see bankruptcy risk within the next year? No, I don't see them like filing Chapter 7 and going bankrupt or whatever. Now, Chapter 11, I could possibly see if, and we'll get more into that in this video, but and we could see here in the earnings call, they basically said they have 205 million of borrowing capacity. So I did, cash plus restricted cash. They have 276 million of liquidity. So obviously, do I see this company go bankrupt? No, not right now. If we're talking Chapter 7 bankruptcy, no, but Chapter 11 possibly, and that's why I put that risk there. But let's just go over some things that I've seen, or let's just go over the assets first, because I think this is important. Because yeah, they might have 2 times the current assets, the current liabilities, but one thing about these current assets is these accounts receivables. And I want to go to my other page here, where I basically see these accounts receivables. Let's just go back for a minute. If we add up all these accounts receivables, they have about $1.1 billion in accounts receivables. So obviously these accounts receivables are not like safe accounts receivables. These are to prime, and let's just go back over here. But we could see here a significant portion of our customer credit portfolio is due from customers that are considered higher risk subprime borrowers. And look at this crap. 18 to 36%. What the hell? So they are charging insane interest rates. And obviously they're going to get a lot of delinquencies. So that's what we have to factor in. And we could see here, right, as of January 31st, 2024, the company's balance of customer accounts receivables was $992 million. And look at this, allowance for credit loss, 179 million. So they are writing a lot of these accounts receivable off that are probably not going to be paid back. And we can see your past due 1 day or greater was $304 million. And then we can see your provisions for bad debts and uncollected, interest. Look at this crap. Look how much this has gone up from 2022 to 23. Obviously, the economy has changed. Stimulus checks aren't pumping out. The Fed's, not pumping a bunch of money to the economy. Look at this. It went from 84 million to now it's 191 million. 127% increase. So this company is seeing a lot of their customers default, not pay. Obviously, if you're charging a 30% interest rate, I mean, that's like crash out interest rate. I mean, if you're charging that much, then nobody's going to pay that crap. I mean, that is insane. So that's another reason why the stock could be cheap, is because people are seeing this absolutely skyrocket. That these accounts receivables could be, it could end up writing 30% of these accounts receivables off. And you know what that does to this company? That makes this company negative equity, have negative equity. And that's another sign of bankruptcy too. And obviously, if we go here and we do that, we do a 30-40% discount on those accounts receivables. It brings the accounts receivables down to 797 million. It takes off almost $500 million in the fair value, and it kind of totally wipes out its shareholders' equity. So it, if we do this, they have negative shareholders' equity if we price that in, and then also on top of that, they have negative operating income. So this company's losing, I think it was like 120 million negative operating income. So we're seeing higher interest rates. These customers are not paying. Fed ain't pumping a bunch of money at the economy, and it is looking terrible for this company. Now let's just talk about what I've seen on the earnings call. Let's go to the earnings call. Um, you can see here that they bought this company Badcock. Okay, I, I don't know who the hell comes up with that name, but optimizing, but a whole bunch of Heblaw shit. Turning to our e-commerce, I saw that this was interesting. E-commerce sales of 109 million, representing a 38% increase. That's pretty good. Another thing they say, I believe they give forward guidance. Yeah. Oh, wait, this is another thing too about them cutting costs. I think this is important. Obviously, with the company losing money, we removed approximately 50 million of annualized expenses from form of headcount reductions, optimizing vendor agreements, and eliminating other operating costs. And they're also going to do 50 million. So they are expected to cut another 50 million of cost in the next 18 months. So that's huge too. They need to get this company back to profitability, and it looks like they are going towards that. And another thing is that they gave forward guidance, which I'm surprised. A lot of these companies that are kind of in this bankruptcy risk area, they don't really give forward guidance because the market does not know how to price uncertainty. So the stock just keeps dropping and dropping and dropping and dropping. And then when they give forward guidance, the stock ramps up. With this stock, they gave forward guidance. We continue to believe that we can achieve annual adjusted EBITDA of between 180 million to 220 million and sales of 2 billion to 2.2 billion by the end of our next fiscal year. They were talking about how 2025 could be the year they come back. Hopefully, because I don't think, if this company keeps going like this, then obviously, if they keep losing money like this, it's probably going to go bankrupt. And if these delinquencies keep going up that they're having on these freaking accounts receivables, I mean, their assets are just going to absolutely wiped away, and they're going to start doing huge write downs. And that EPS is going to look pretty terrible. Another thing I saw in the recent 8K, the company borrowed 25 million under the term loan agreement in connection with the borrowing. And we can see here warrants. They exercised some warrants, 1.7 million of common shares. So that's another risk too. Is you have the stock offerings they could be doing, and then they delay their 10Q, which was pretty odd. But they basically said they're refinancing their company's credit facility, and has not been able to complete the disclosure required to be included on the form. So obviously, delaying your 10Q is not a good sign. Pretty sure there's a statistic out there that shows that when a company delays its 10Q, there is high odds of it filing bad earnings. But this company, let's go to the tangible asset value, guys. Obviously, I use the tangible asset value because I don't want to get into the fair value and calculating fair value. The video would take forever. But tangible asset value tells you a lot. It basically tells you the fair value of the company. This is what I use most of the time to find a fair value. Of course, it's not 100% true because sometimes, like this company in particular, those accounts receivables, with most of them being that they probably will end up being in delinquency, about 30% of them, at this time. Obviously, you take that off the balance sheet, but we could see here, right, 614 million in tangible asset value, and now it's dropped to 435 million. So it is deteriorating as time goes on, and as this company continues to lose money. I have not looked at the new one. I should look at this new quarter, but I'm pretty sure the earnings are coming out soon. So let's go back to the base. Let's just end this video off, right? Pretty sure it's gonna be a short video. I'm trying to make these videos like 12 minutes. But we can see here it only has 7% in short interest. I think it's like 6 point something percent, but it's very low. The company is only trading for $50 million market cap, so it's almost under that micro cap area. under that $50 million. I put it as 200-300% upside. I think obviously if this company can make it through and become profitable, I think this company will ramp up. Now, my fair value on it with these delinquencies, if 30% of those delinquencies happen, then this stock has negative equity and it's not really worth anything. But I think that if this company can sell that and people believe it, that this company can make it out of bankruptcy, I think it will obviously ramp up because that's what we're looking for. And I put the downside of 100% like all these stocks, obviously with this bankruptcy risk, and I put 20 to 50% bankruptcy risk. I think these delinquencies will continue to ramp up. And also, this company does have release, I think 270 million of these accounts receivables that you can see every month. So you can see the delinquency rate on those too. But I'm not going to get into that in this video. And EPS, they reported this quarter was negative 125, so they are losing a lot of money. I mean, that's like more than half the share price right now they're losing, and they're expected to lose 65 cents next quarter. And on NASDAQ, they were expected to become profitable in 2025 on their, I don't know where they're getting them, but I didn't believe it. But this is from Tipsy Ranks, I think it's called. But yeah, negative 65 cents a share. Alrighty, guys. I'm pretty sure this is going to be a short video. If you like it, like and subscribe. And also, if you guys have any other information on this stock, share it down in the comment section below. Obviously, we want to know all the facts. And remember that this information can easily become irrelevant tomorrow because many things change in the market. And obviously, if something happens at this company, like they get a new loan or they start issuing more stock or something like that, we start seeing different things. But as of the date, 6/19/2024, we could say that this company, I see about 20 to 50% bankruptcy risk, and it looks all right to me. But would I buy this myself? No, I'm not buying it myself. But I feel like if you want to take a gamble, go ahead and buy it. But most likely, your investment will end up going. You will end up losing all your money. All right, guys. Well, that'll end the video officially. Like and subscribe, please. And my Big Lots video is doing pretty good, guys. If you guys want to watch that one too.